Hi, and welcome to part 2 of chapter 2 of investments. We're going to start off with globalization. So when you think about the stock market, you need to think about the entire world. And when you think about your portfolio, you want to think about diversification. So diversification is a way to manage the risk of your portfolio. So the more types of different companies from different countries that you include in your portfolio, you're going to help increase more stable returns and reduce risk through diversification. Now, you want to hold in your portfolio, you don't want all tech stocks. You want to have a wide range of different industries and securities, stocks and bonds, and from different government and corporate, stocks from different industries in different countries. So, stocks can be traded in a large number of markets around the world, and you want to make sure that you have the best of what the world has to offer. So there's a big importance of international markets coming up in Asia and Europe, and in the Americas. These markets contribute a significant amount of the total outstanding value of securities and some of the most valuable companies that are going to have extreme growth moving forward. So the international investment performance is strong. It varies though. Some years the US stock market is the best stock market. Most years it's not. Most years it's a foreign market that has the best returns. So there are multiple ways to invest in foreign securities, and the risk of investing internationally is a little bit different than investing domestically. Now, let's just move back into how international markets are growing in importance. There are stock markets or security exchanges in over 100 countries worldwide. So that's almost half of the countries on the planet have some sort of high functioning stock exchange. The biggest exchanges typically are the New York Stock Exchange, the NASDAQ, the London Stock Exchange, and the Tokyo Stock Exchange. But there's been an increasing amount of mergers, acquisitions, that these exchanges have been occurring, especially between the New York Stock Exchange and some European exchanges. These exchanges are becoming more global and less localized. And bond markets, too, have also become more global, and trying to consolidate their markets. So no longer are stock markets only designated by the country of origin. These stock markets can now be, through mergers and acquisitions, a market that's going to include domestic and foreign together. Now, international investing has a lot of potentials because the country that you may be from or living in, they may have a smaller stock exchange, or they may have a stock exchange that doesn't include some of the hottest performers. So there are opportunities for higher returns by looking beyond your local stock exchange. So, and there's also better diversification because some stock exchanges don't necessarily move in the same direction as a U.S. stock market exchange. So their betas are different, is what we'd call it. Beta is something we're going to talk about in a later chapter, but basically they may move in different tracks. So when the U.S. market is going up, certain foreign markets may be going down and vice versa. And of course, foreign markets can be riskier, and it depends on the foreign market because each different market has different set of rules and regulations. They have different accounting, different security laws, different currencies, different political aspects. So there are different additional risks in investing in foreign companies. So how are some ways to invest in foreign securities if you use a domestic brokerage? Well, you can invest shares in U.S. multinational or foreign multinational companies that have a significant amount of their business in foreign operations. So their companies are not, big companies usually are not 100% domestic. Large companies will have business interests across the world. So buying a local company on your local exchange, it may be a domestic stock, but they might have more than 60% of their business internationally. So that's giving you that's giving you some foreign exposure. Now, you can also purchase securities directly on a foreign exchange. So if you have a brokerage account, say Fidelity, and you want to buy a stock from Canada through the Toronto Stock Exchange, you can do that. There's generally additional commissions you have to worry about, and you have to worry about the differences in exchanges between currencies. Now, you can also buy foreign companies that might trade on the U.S. Stock Exchange. So the U.S. Stock Exchange has dual listings of companies who are located in their domestic stock exchange, but also are listed in the U.S. Stock Exchange. Think of companies like, there are many Japanese companies like Honda, Toyota, Sony that are listed on the New York Stock Exchange. So there are many foreign companies that are big enough that they're able to list on the New York Stock Exchange. You could also buy what's called American depository shares. So these are foreign stocks that are traded through U.S. stock exchanges. So they're permitted to trade to U.S. investors to hold shares on non-U.S. companies, but they're traded through the U.S. stock exchange. So this is different than a dual listing. So you could purchase stocks that, like Sony is listed directly on the stock exchange in the U.S. and it trades like a U.S. stock. But there is this depository shares where if you're not able to fully dual list your stock on both exchanges, shares from your domestic exchange can be converted in a way that they can be issued through American depository shares, and they're going to basically change the stock price from the foreign currency to dollars, and and then a certain amount of receipts for stocks of these foreign companies will be held in banks in the companies of the home country to back up the shares. So it's just another way of offering U.S. investors to buy foreign stocks through a domestic exchange. And most of the times, if you're buying these foreign stocks through a domestic exchange, you're not going to know that's an ADS shares or if they're just a dual listed share. It'll just seem seamless to you. Now, only the really biggest foreign companies will be dual listed typically. But let's talk about some risks of investing internationally. So this is going to be the point of view mostly from established economies. If you're going to be investing in smaller, less established economies or exchanges, there could be governmental political risks, which means that some foreign governments are unstable. Some foreign governments are run by a dictatorship that may change the laws of investing or change the money flow pretty quickly. It may decide that no money is going to be able to leave the country once invested. They may have different laws in how they trade or their union or taxation, different economic and political conditions in the country. Their regulation of the stock market could be much less than what you're used to in your domestic market and not really follow up as tightly or as controlled with companies' filings. Now, I would always say that the biggest risk is also the currency exchange risk. And this is when, if you've ever traveled and you go to, if you travel between the United States and Europe or United States and Asia, there's different currencies and they have different exchange rates, which fluctuate and change. So you might buy a foreign stock in a foreign currency, and the stock may never change the price. You may buy it at $10 per share. You might buy it at 10 euros per share, and then sell it at 10 euros per share. But if the exchange rate between the euro and the dollar, say the dollar weakens, that's going to affect what the amount you're going to receive. So if you have money invested in euros and the dollar weakens, you're going to get more than $10 back. You might get $11 back, even though the stock never changed. But what changed was the value of the currency. So that can be a significant addition or subtraction to your overall gains in directly investing in foreign markets. Now let's talk a little bit more about the structure of domestic and international securities markets. So there's the trading hours of the security markets and the regulations of the security markets. Now, the trading hours for the U.S. markets are 9:30 a.m. to 4 p.m. Eastern Time. Why Eastern Time? Because most of the markets are in New York. So you cannot trade stocks on the New York Stock Exchange before 9:30 or after 4 p.m. Although there are secondary extended hour electronic trading sessions, ECNs, where you can trade on extended hours, but that's more expensive and typically not as liquid. Now, the stock market is not a 24-hour market, so orders are going to be filled with whenever the market is open or is going to open. So that timing makes an issue too. It makes the complexity among trading stocks between different countries, different exchanges. You have to know when the hours are. And, the stock price can change significantly if you place an order overnight and it's going to trade first thing the next day. The price can trade significantly through these ECNs before when it opens up. And that's another risk. Now, as far as regulations on securities marketing companies change from time to time. Laws change, and it's definitely different between countries. Now, in the U.S., there's been a number of regulations placed on stock trading, stock markets, companies, with one of the biggest occurring in 2002. So the Sarbanes-Oxley Act was created out of the frequent fraud that was uncovered in U.S. companies such as Enron and Global Crossing between the year 2000 and 2002. That was just, falsifying revenues, falsifying profits, just, fraud related to accounting information and unfair practices between auditing companies and business relations. So the Sarbanes-Oxley was developed to help to eliminate corporate fraud and put more responsibility on accounting officials and financial officials when they release financial statements, hoping to make the likelihood of fraudulent financial statements a thing of the past. Now, also, a Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 was passed, and this was aimed at promoting more financial stability in the U.S., improving accountability and transparency in the markets and in the financial markets, and creating a bureau in consumer financial protection to protect consumers against predatory banks, predatory credit card, and predatory practices that were meant to keep people in debt and keep people accumulating debt. So moving on more to today's times, ethics have been being updated in standards of conduct, your moral judgment. This continues to evolve as companies strive to become more ethical. They strive to become more of a representation of the people they serve. So as time passes, as administration passes, regulations change. Now let's go way back to the blue sky laws. These laws were imposed by individual states to help regulate stocks. And they're intended to prevent investors from being sold nothing, which they call the blue sky. So back in the Wild West of stocks in the U.S., we're talking about, say, around 100 years ago in 1920. So we had a situation in the 1920s, which is called the Roaring Twenties, where stocks were being sold that didn't belong to any company. All they were was a post office box, if even that. So there was a lot of fraud and a lot of misrepresentation of what people are buying in the stock market. And a lot of what they're buying was simply nothing. That was all hype and speculation and really was not even a company. So these blue sky laws were first set up by states before the federal government even got involved to try to prevent this type of fraud. And as things got worse, that we had the crash of 1929, one of the biggest stock market crashes, and which was followed by a Great Depression around the world. Now, the economic conditions were terrible. So many people, the average person in 1928, 29 had money in the stock market. And many, many people, not only average people had money in the stock market, they had highly leveraged positions where they borrowed money and they invested their money in the stock market and borrowed more money and invested that in the stock market. There's no limits on how much money they could borrow. So people were very highly leveraged. When the stock market started to collapse, people got caught where they their stock accounts went negative, and they basically lost everything, more than everything. So because of the devastation that stock market crashed and the following depression, which was the result of other economic factors and bad decisions that the government made as well, but because of this bad economic times, and a lot of it was blamed on the stock market, but it was not 100% the stock market's fault. Regardless, in 1933, they started to take action, and they required full disclosure of information by companies. And by doing this, they sort of eliminated the need for the states to have individual blue sky laws, because now the federal government was going to step in and create specific guidelines on financial disclosure. Now, the Securities Exchange Act of 1934, this is what established the SEC as the government regulatory body. And this basically set up their own organization within the government to monitor the stock exchanges and the financial exchanges. In 1938, they made a modification to allow a self-regulation of the NASD, which is the National Association of Security Dealers, which later becomes morphs into the OTC and the NASDAQ. Now, the self-regulation basically allows this particular exchange to monitor and regulate themselves, with the threat of the government stepping in if they don't properly regulate themselves. And it's sort of like the movie theater industry in the U.S. is self-regulated, meaning that those PG-13, R rated films are self-regulation. It's not imposed by the government. Okay. The Investment Company Act of 1940, this was developed and created to regulate mutual funds, to make sure that mutual funds were fair and regulated for investors. The Advisors Act, also in 1940, required investment advisors to make full disclosures about their backgrounds and their investments and register with the SEC. Because so much fraud was starting to be perpetrated by investment advisors, the SEC decided to crack down and make them more responsible, have them register, have them pass certain tests, and have them disclose their investments, so they couldn't manipulate the markets as well. And all these acts were created in an attempt to make the stock markets more fair and prevent another disaster. Okay, continuing, the next big set of regulation change came in 1975. In 1975, they abolished the fixed rate commission. So previously, the government set the commission rates between trading stocks. Now, by abolishing that fixed rate commission and establishing electronic communication networks, in order to make stock prices more competitive and stock market more liquid, this had some interesting results. In 1975, by abolishing the fixed commission schedule, that allowed for the discount broker to be developed in the 80s. And then after that, it allowed the commission-free brokerages to be developed, where people can trade stocks commission-free. So, and I remember early on, commissions have steadily been reduced, and this is what you pay the brokerage when they trade a stock for you. I remember, starting out in the beginning, commissions were almost $100. In today's money, that would be like $200 to trade a stock. It's very significant and very limiting of people. The discount brokers help bring the trading commissions down to $35 a transaction. So if you were to buy a stock and then sell a stock, you're paying $70 in commissions. Really exorbitant. So that's why I kept a lot of average people out of the stock market, these very exorbitant commissions. And as brokerages became more competitive, commissions started going down and down and down. Today, most commissions are below $10, and a significant amount of commissions are free in trading. And that is the markets in action. So it's actually been overall a good thing for investors. But on the bad side of that, it may encourage investors to trade more frequently than they should, because commissions are so inexpensive, bringing to the rise of more day trading. Okay, in 1988, the Insider Trading and Fraud Act was developed, and this is to prohibit and put more controls on insider trading. So any non-public information was illegal to trade, so it gives you an unfair advantage compared to the ordinary investor. So the SEC still to this day closely looks for, monitors, and prosecutes people for insider trading. In the year 2000, the Fair Disclosure Act was developed, and this required companies to disclose material information to all investors at the same time. So if a piece of news was going to come out, it used to be before 2000 that companies could share that with their analysts first, and the analysts could then issue recommendations based on this information before the average investor would get it. The Free Disclosure Act ensured that if a company was going to release a piece of information, both institutional and small investors would get the information simultaneously. And with the advent of the internet and how quickly information can be dispersed, it was very easy for companies to comply to this. Now, as we talked about before, in 2002, the Sarbanes-Oxley Act was developed to help tighten and increase regulations on accounting and audit guidelines to help reduce corporate fraud, which was a big problem prior to 2002. And then in 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act that we talked about earlier. And this was, again, trying to create some financial stability for citizens of the country, improve accountability and transparency, and help reduce abuse of individual customers by financial institutions with using tricky contracts and tricky promotional schemes to get people into loans or credit cards that were predatory, that had extremely high rates of interest or complexity that the average investor didn't understand what they were getting themselves into, or average loan buyer. And part of the reason for this Dodd-Frank Wall Street Reform Act is in response to the real estate boom that was fueled by so many gimmicky mortgages and mortgages given to people who really could not afford them. Okay, so the next set of tables, I have 3 sets of tables here, which is going to give a little bit more specifics of the new federal security laws. All of these I've gone over before, but this is just a little bit more detailed background that you could, if you want to look into some of these and get a little bit more. And this could help with, possibly with tests that are coming up, could be based. So this is a great way to get a nice summation of these different acts. Okay. Now moving on to basic types of securities transactions. So now we're getting into the mechanics of trading stocks. So an investor, there's a number of transactions that you can make as an investor. And, so brokerage firms are going to offer you different ways to buy and sell your stock. And there's different terminologies. So we're going to talk about the long purchase, margin trading, and short selling in the upcoming slides, and help to define these terms. Let's start with the long purchase. Okay. Think of you understand these 2 terms, long and short. In the stock world, long is associated with buying a security. So when they say you're going long, that means you're buying a security and you hope that the value goes up. And of course, short purchase is selling the security. We'll get to that more in a minute. Now, the long purchase, the object is to buy low and sell high. So when people ask me for stock advice, I always tell them buy low and sell high, or sell high and buy low. This confuses them significantly enough where they don't bother me anymore. But you get the approach here. You want to buy stocks low prices and sell them at high prices. That's what we're trying to do. And it's the most common type of transaction. Now, and returns are going to come from, of course, the capital gains, the difference between the buying price and the selling price of a stock. But you can also make some money through dividends and interest depending on the type of financial security you purchased. Now, of course, anything you buy has to also, there can be transaction costs that you have to subtract out of your return. I think most everybody is familiar with buying a stock, selling a stock, or what we call in the market, people in the know will call a long purchase. Now, margin trading is when you basically borrow money. So the brokerage will be happy to lend you money. So if you have $100, the brokerage would be happy to lend you an additional $100 so you can make a trade worth $200. So you can take your $100 that you have in your account and make a trade equivalent to $200. And then that would be margin, traded on margin. So margin refers to your equity, though, the amount of money you have in your account. And that is the basis of how much they'll loan you. So the margin requirement, as far as set by the Federal Reserve in the US, is 50% for stocks. So the minimum amount of equity, or the minimum margin that you have to provide for a transaction, is 50% of the total transaction. And that's a margin requirement. So if you wanted to, if you wanted to buy $1,000 investment in a stock, you would have to put up 50% of that, or $500, and that's your margin. And then the dollars loaned would be the other 50%. Now, the idea of trading on margin is to employ financial leverage, to take your money and magnify it. So this is going to greatly magnify your returns. So if you have $100 and you invest $100 and the stock goes up at 10%, you make $10. But if you take your $100, borrow $100 and make a $200 investment, it's still only $100 of your money. And if that stock goes up to, it's going to go up not $10, but $20, because you have now $200 worth of the investment. If it goes up 10%, it will go up $20. So your $100 investment actually made you $20, which is a 20% return on your capital. So that's the effect of leverage, magnifying your returns. Now, the margin loan, or the dollars loan, is a vehicle which the funds are made available for margin transactions. Now, you can't easily open up a brokerage account and instantly trading a margin. You have to qualify and pass a little bit extra forms and to be able to be considered and qualified to trade on margin. So when you open a brokerage account, you're not initially able to trade on margin or even short shares of stock or buy options. These are additional things that you have to apply for additional approvals later on in your brokerage account. Okay. So here's just a mathematical look at investing with margin and the changes of your return based on the change of stock price. If stock prices rise to $80 or if they lower to $20, this shows you the effect of margin on your returns. So you can look this over. It's pretty simple math here. Okay, so let's talk more about margin trading. So the advantage is, of course, it's going to magnify your returns if you're making the right investment. And it allows investors to spread their limited capital over a larger number of investments, because it's basically doubling your potential amount of money for buying stock. Of course, the disadvantage is it's going to also, as much as it can magnify returns, it can magnify losses. And there's going to be a cost, an interest rate to the amount of money that you're borrowing. So you will have to pay interest rate, and usually significantly higher interest rates than the prime, on this money you borrowed. So if the stock takes 10 years to double, you're paying interest all along until the stock doubles. It can take a significant amount of your magnified returns away. Now, when you do have a margin account, there's some things you have to learn about how the account's going to work from the brokerage's point of view. So if you establish a margin transaction and you're going to make a contribute of $2,000 of your equity of the purchase price, which means that you can make an investment up to $4,000 or 100% of your equity, which means basically the total value of the position can't be more than 50% of borrowed money. So your initial margin is going to be provided by, that's the initial amount of equity you put in your account, the money you put in your account. Now, a restricted account is an account where the equity is less than the initial margin requirement. Your account becomes restricted. And then there's a margin maintenance, which is investor must bring extra money in to maintain that margin account at all times. So if your margin account, and there may be a separate maintenance percentage, so you might have initial margin of 50%, but have to be required to put more funding in the account if it drops to 45%. and you'll have, so basically they'll make a margin call, which is going to say you need to bring money to your account to bring up your equity percentage or your above the margin maintenance. So the debit balance is the amount of money being borrowed in the margin loan. There's just a term there. So why do they do this? Well, basically, if you buy a stock on margin and the stock price goes down, they never want to be in a position where the brokerage is going to try to have to collect money from you. So they want to always have it, at least a certain amount of money in the account to cover the losses on the stock. And when it becomes too close, they're going to ask you to put more money into the account to cover the losses incurred by the stock. Because again, the goal here is never to have any brokerage account go negative. Now, if you don't comply, they have the ability to automatically sell the stock, which is, so if there's insufficient funds in the margin call, they're going to sell the stock on you to make sure that you don't get in a position where you owe the brokerage money. So it's all about preventing things that happened in 1929 when there was no limits on margin. Okay, so let's look at some of the margin requirements. So for common stock, you get a 50% minimum equity. Margin is equity, so you have to bring 50% cash to the transaction. Same things with the NASDAQ, convertible bonds. Now, corporate bonds, you only need to put 30% equity. So you could buy a $1,000 bond and only put $300 of cash into your account because bonds are safer. Corporate bonds are safer. You don't need as much equity because they're not as volatile as stocks. Now, government issues are 10% of market value or 6% of principal that has to be in equity or cash. And options are the premiums plus 20% of the market value of the underlying stock. And futures are 5% of the value of the contract. So depending on the financial instrument will determine the initial margin or equity you have to bring to the transaction. Now we have a couple of formulas to help calculate the basic margin formula. It's just going to show you your margin percentage. And it's the value of the securities, which is, the current value of the securities, whatever the stock price is times the outstanding shares, minus the debit balance or the money you borrowed. And this will give you a percentage. So if the current stock, and remember, this value of securities at the top and bottom are always identical. They're the same variable. So if the current value of the securities is $6,500 and you borrowed $1,200 as your money from the brokerage, when you divide these two numbers together, you get 81% margin, meaning 81% of the transaction is your equity. Okay. Now, as far as return, if we're looking at return on invested capital for a margin transaction, it's a little bit different. So what we're basically doing here is we're going to take the total income received, any dividends, minus the total interest paid on the margin loan, plus the market value of the security at sale, minus the market value at purchase, divided by the amount of equity at purchase. Okay. So basically saying if you put $2,500 into an investment, okay, that's the amount of cash you put up. You may have borrowed $5,000. So the market value of the initial purchase is $5,000. So we're getting these two numbers. You get $100 of dividends. You paid $125 in interest, and the ending value of the stock went up, say from $50 a share to $75 a share. So now you have $7,500 in the market value at sale. So that's going to give you a profit of $2,475 divided by your initial cash. It's a 99% return. So this is an example of how you could calculate the return of invested capital while utilizing margin. Okay, so there are some uses of margin. Of course, you want to magnify your returns. So if it's a bull market, things are going well, many investors are only going to do better by borrowing on margin to increase their exposure. And then as the stock prices move up, your equity position increases. So as in a bull market, stock prices go up, the amount of equity in your account increases, which helps increase the amount of money you can borrow. So pyramiding is really just using the paper profits in the margin account or the equity to partially or fully finance the acquisition of additional securities. So as the market grows, stock prices go up, your equity position grows, you can take on more margin. So Excess margin just means you have more equity in your account than required. Remember, margin means equity. Equity means the capital that's yours in the account, not money that's been borrowed. So when additional securities are purchased, your margin account must be at above the required initial margin level of 50%. And the risk associated is if prices start to decline, your margin, your equity will be declined, and you're going to be asked to add more cash to your account to maintain these positions. And if you don't have that cash to add to the account, they'll sell your stock to satisfy that. Okay, moving into short selling. And short selling as, in the last couple of years, short selling has really come to the forefront where more small investors know about short selling now and the practice of short selling, and are even dabbling in short selling. I find short selling to be extremely risky based on the fact that there's unlimited losses associated with short selling. Because if you buy a stock for $10 and the stock goes to zero, you can only lose $10. If you sell a stock short at $10 and the stock goes to 4,000, 40,000, 100,000, you've just lost tremendous amounts of money. So short selling can really be a dangerous thing to do. It's often a tactic of hedge funds to prey on small stocks or weak stocks or stocks that have declining industries, to pile on top of these stocks excessive amounts of short selling. And we saw this occur with AMC, GameStop, Tilray, certain industries where the large investors smell blood in the water or see a decline in the overall business valuations and aggressively short sell, which aggressively pushes the stock lower, which in turn makes it more difficult for these companies who are struggling to issue new shares of stock, to raise new money, to become, to help them out of their declining business or switch their business models around. So really can restrict the ability for them to raise new capital. So short selling has a lot of negatives associated with it. Now, the practice is difficult for people to conceive because you don't do this in your real life too often. In your real life, you're pretty used to buying a stock and then selling it. Buying an item. Like maybe you buy a car and then you sell a car. Pretty easy. But nowhere are you able to sell something first and buy it later. But the stock market, through the managed practice of borrowing existing securities from one investor, giving them to you to sell. So you're basically, a broker will shuffle their shares around, because when you buy stock through a brokerage, the stock really goes in the brokerage's name, not your name. So they're able to take your shares and lend them to somebody else, and they can sell those shares. So they're really selling your shares. You have no idea this is going on, and the brokerage will guarantee your shares if you need to sell them. But in the meantime, they're letting somebody else borrow them to sell them, so that person can sell the stock first and go into a short position, thereby making money if this stock prices go down. So because the brokers, like I said, the stocks are really held in the street name or the broker's name. So they can do whatever they want with your stock shares because they're not in your name. So investors, what they'll do is they'll make a deposit with the broker equal to the initial margin that's going to be applied to the short sell. And then the broker then again is going to retain the proceeds from the short sell. So here you want to sell high and buy low. And so of course investors make money when prices go down. But I don't really recommend anybody do any short selling because the risks involved. You're better off buying a put option, which is like a short sell, but you don't have unlimited liability with a put option. Okay, so let's talk about the mechanics of short selling. Step one, the initial short sale. So there's 100 shares of a stock that the brokerage has borrowed from somebody else and allowing you to sell at $50 per share. So this proceed, you basically sell and get $5,000. That doesn't leave your account though, until you what they call buy to cover later on. So when the short sale is covered, that's usually called buy to cover. You're going to buy back 100 shares. Maybe you buy them back at $30 per share. So now the transaction is settled. The $5,000 you made from selling it in the beginning, $3,000 that you paid to buy and settle the transaction. So the net profit is $2,000. So basically, when you look at the stock price per share, you can have two situations. Here, the stock price is going down to $30 and going up to $70. So in each case, you have the proceeds from the initial short sell, and then there's a margin deposit on the short sell, because short selling is all on margin. So the total deposit with the broker. Now, if the costs go down, the price goes down, you're going to make money. If the stock price goes up, you're going to lose money and may even face a margin call. So the advantages of short selling is there's a chance to make profits when stocks decline. So if there's a bear market and everything's going down, and typically with bear markets, when you're in a real bear market, it'll take about usually 6 months for prices to settle. And those are 6 months where it may have taken 10 years for the price to go from $25 a share to $200 a share. And within 6 months, that price can go back down to $25 a share. So it's usually the most volatile period. So short selling during a stock market crash or a bear market can make people a lot of money. But it's a limited opportunity, because once the stock price hits zero, there's no more money that can be made. So where buying a stock long, you can make unlimited amounts of money, such as Tesla going from $20 a share to $2,000 a share. So these unlimited risks, the stock price can go up and keep going up. And this is going to make short selling very risky. You have this unlimited risk side. So if prices go up and you can't maintain your brokerage, the amount of dollars you borrowed in your margin account, they're going to do a call on your short position. And short sellers never earn a dividend, and they must pay the lender any dividends that they receive on the shares that are sold short. So you get no advantages of any dividends. So again, although people who are day traders might fancy themselves taking a varied amount of positions, long positions, short positions, maybe even dabbling in option contracts. But this all generally, for most day traders, I've never met a day trader who was successful in the long term. I've met plenty of day traders that are successful during bull markets, but once that first bear market comes in, they typically tend to lose everything and more. So it's not, day trading I would not say is a career. Day trading is not something I'd say I would advise people to do. I would say long-term, dollar cost averaging investing has been the most, the highest returns with the lowest risk over time. Although it's good to know about short selling and margin accounts, because they do have their advantages. And when you become a more experienced investor, you may want to leverage some of the margin or equity in your account to take bigger positions, especially during the start of a bull market. Okay, so that's it for part 2 of chapter 2. I look forward to talking to you on my lecture on chapter 3 of investments. Take care.